explaining what you never understood about Capex calculations. This is the Capex lesson for those of you who have worked with Capexes for years but don't have a master's in corporate finance. How many of you have taken any type of corporate finance classes, the ones that go really into the depth of valuations? We assume you're a typical professional within the capital-intensive industry, because normally we meet people who have worked within manufacturing or technology, or controllers with mainly an accounting background. People who start out in mills or slide into being part of the Capex management process from some unexpected direction. These people rarely have 2 semesters of advanced valuation classes from a university. Today we're going to talk cash flow and the math around Capexes. There are pitfalls in your Capex management process that we don't go into here. Read our white paper, The Tail Wags the Dog, for understanding those. That will explain how to avoid poor decisions and make better ones instead, creating better future cash flow for the company and its owners. What is cash flow? There are different types of cash flow. First of all, people talk about cash flow when they talk about liquidity, such as, do we have funds for this investment? Can we finance this? Can we take a loan? All of that is about cash flow. It's also common that people talk about cash flow when it comes to answering the question, is this Capex or business good or bad? Trying to judge whether or not this is better than that, they talk about cash flow. So in this case, it's about performance, profitability, or value. However, those 2 ways of talking about cash flow are not the same thing. Those are different types of cash flow. For instance, you cannot use the cash flow used when talking about liquidity or financing in trying to understand if something in an operation looks good or bad. That's not possible. You also can't talk about value profitability and then try to understand if you have the funds by looking at the Capex calculations cash flow only. Again, it is not the same thing. Here we have a typical cash flow statement adjusted slightly for the purposes of this presentation. The top line is sales. Then we have the variable costs. We have fixed costs, and then we arrive at the EBITDA, earnings before interest, taxes, depreciation, and amortization. Depreciation is not a part of this statement since it is not cash flow. EBITDA is the money you make in the profit and loss statement before you get to depreciation, and interest, tax, amortization. In this case, the EBITDA was 200 and sales were 1,000. The EBITDA margin is therefore 20%. The EBITDA isn't actually all cash flow because of various periodizations due to goods in progress, receivables, payables, and so on. You need to make an adjustment. It is not correct if you don't. The adjustment is called the change in working capital. Then we have tax, which is the tax you pay on the EBITDA of 200. But you have 2 so-called tax shields that will lower taxes paid. 1, you pay less tax due to the tax depreciation that you have. Don't confuse this with the P&L's depreciation. It is not the same thing. 2, you also have a tax shield from interest payments that you make as a company if you have debt. So taxes paid nets in this case out to the 15, we can see in the statement. Then you have investments, the Capexes or capital expenditures. However, this row excludes expansion. We'll get to why in a bit. On this row, called Capexes excluding expansion, you need to include all the Capexes that you need to spend in a mill or plant to preserve production, to keep customers long term. You have to make sure you can serve the same customers 5 to 10 years from now. This row is likely to cover 90 to 100% of all your Capexes in a year. These Capexes do not create value. They maintain the value you once created when you built this mill or plant, and an estimate of those should have been in the mill's original greenfield Capex request. The next row is a row called operating cash flow. In this row, you deduct the expansion Capexes. This is mainly new capacity, either an acquisition or expansion of an existing mill or plant. The creep of a mill's capacity by 1 to 2% per year is not what we call expansion. Capexes for creep need to be in the Capexes without expansion row. Next, you get to cash flow after Capexes. After that, you have your interest payments and amortization for your debt. Then you pay your dividends to your owners. Finally, you arrive at the company's net cash flow, which over time hovers around zero, unless the company adds liquidity to the bank account. This is a direct cash flow statement as opposed to an indirect cash flow statement that starts from profits and adjusts back to cash flow. If you talk about liquidity or financing, you need to talk about EBITDA, tax, capex levels, interest payments, amortization, etc. You need to talk about the whole sheet. That's all we'll be talking about, that type of cash flow. We won't be talking any more about financing or liquidity. Instead, we will talk about value, performance, and profitability cash flow. With that in mind, where do you then focus in this statement? 1. Well, you need to understand everything above the line operating cash flow, because that line determines the value and profitability of a mill, a group of mills, or of a company. The line operating cash flow defines the mill's ability to generate cash flow after the capex is necessary to keep the business long term. 2. Then you must also consider the success or failure of your expansion capexes. Remember, on an average, globally across all industries, by default, half of all companies succeed with their expansion capexes and half fail. These two lines together determine value and performance. Now let's take a step back for a moment. Within a company, how the company looks at cash flow is rarely discussed. Why that measure, or KPI as some would call it, is used for determining if a capex brings value or not. Have you ever thought of or discussed that in your company, how you look at cash flow when it comes to investment calculations? You look at cash flow, future cash flow, and you use NPV, internal rate of return or payback, or something similar to evaluate if a capex is good or bad. There is a reason for that, which I'll explain now. We go to the capital market to find the reason. The market for bonds in most Western countries is a functioning market, an efficient market. You can track the valuations of bonds well, and you can understand what drives that value. The way it works on the bond market is that you buy a bond for, let's say, a duration of 3 years. You pay for the bond, and after 3 years pass, you get the money back again. Every year, that bond pays out interest to the bondholder. In this case, it is $50 per year. In the third year, you get the $50 and you also get the nominal value, or face value of $1,000. It is implied that the nominal interest rate is 5%, 50 divided by 1,000. The nominal value of this bond is $1,000, but you don't pay $1,000 for it when you originally buy it. And that is the interesting part here. So what do you pay, and why? The bond market's expected or required return from bonds goes up and down all the time. Every second, potentially. 1 minute, it can be 4.85%. The next minute, it can be 5.05%, and so on. It is not determined by what the interest of a bond is. Not at all. So if the market's interest rate, expected or required return for this type of bond is 4.8%, then the value of this bond is calculated like this. What the market does is simply picks the payments the bond has to make, 50, 50, and 1,050. Then the capital market, which is the sum of all the participants on that market, discounts it by the market's required rate of 4.8% and comes up with a bond value of $1,005. In other words, the market sets the bond prices and the required rate of return can be calculated from that. So if you go to the market this very second and want to buy this bond, you will pay $1,005, not $1,000. This value of $1,005 is not connected to the nominal value of $1,000. It is only connected to the payments that the bond has in the future discounted. Discounting is a term that we will come back to in a while. If you aren't comfortable with the discounting technique right now, you will be after having watched this entire video. Eventually, we can conclude that the value of this bond is a function of the cash flow generated, the interest payments of $50, the life of the bond, 3 years, and the capital cost of 4.8%. That's what determines the value of this bond. One cannot bring in another parameter to the equation and come up with a better quality value. The way we did it now is how it has to be done. What's interesting about this is that it is actually not something that someone made up. You can observe it a billion times per day. This actually happens over and over again. It is not driven by opinion or theories or anything like that. Nobody told the market to do it this way. You can go out and observe this, track it, prove it. Now let's move on to something that is not as easy to track or prove. Valuations on the stock market. Individuals on the stock market evaluate P/E ratios, company profit, MVA, and all kinds of measures that, at best, on a sunny day with all the planets aligned, maybe are indicative. Let's instead look at fundamental valuation. On the stock market, valuation works in the same way as the bond market, actually. You look at future dividends, either into eternity and the growth in those dividends, or you look at what you think you can sell it for in some years going forward. And then the calculation is the same. Or you look at the company's fundamental ability to generate long-term cash flow. Here, the value is again a function of cash flow generated, the dividends or the company's cash flow, expected sales value, the life, time to sale or indefinite, and the capital cost. The capital cost here is going to be higher than the 4.8%. The cost of stock market equity is higher than that of debt. So, now that we understand how valuation of cash flow works, let's move on to the valuation of a capex. When evaluating a capex, you look at the cash flow it will bring in the future, for how long that cash flow will come in, and the capital cost, often the weighted average cost of capital, which we will look at later. Then you compare it to the capex outlay and determine if the net brings value or not. So, value here is a function of the same things as on the bond and stock markets. Value, profitability, and performance can only be determined by looking at these variables up to the right. If you take any of the variables above out of the calculation or try to bring something else into this, you have ruined the valuation. You cannot go to the government bond market and try to pull one of those three out of the equation, or put something else in the equation, and try to determine the value of something. It is impossible. It's the same with capital expenditures. For the clarity and simplicity of this editorial, we will not go into real options and the value of flexibility. Now we're going to talk more about capexes as such. What is the purpose of a capex? That question can have various answers, but if you go back to the origin, why does a company make capital expenditures at all? The purpose of a capex is to create value for the company's owners. If you have a company that is assumed to, over time, have less capexes with positive net present values, green X's in picture A, than capexes with negative net present values, red X's, then that is a company that over time reduces the value for its shareholders. The company's share will not perform above the stock market index. The average company within the pulp and paper industry, for instance, never reaches an NPV of 0 on their average Capex decision. So that industry slowly removes shareholder value over time. Again, we're talking about the average performers. There are exceptions. In other words, the average never reach a discounted payback of their average Capex project in that industry. We'll come back to the term NPV and discounted payback in a while. The other type of company is a company that over time makes more positive NPV Capex projects than negative, picture B. This company will beat the stock market index and provide the shareholders with a good return, above average. Please see our video, Dysfunctional Capex Processes in Capital-Intensive Companies, for more on the reasoning around the X's. In the capital-intensive industry, the key to turn around a company is to make fewer poor decisions and more good ones. You set your future when you make your Capex decisions. After those decisions have been made, you can only do what all other companies do: manage the result of your decisions in the best possible way. Now we are going to talk about capital costs. The term capital cost has come up a couple of times, so let's talk about it a little bit. What is capital cost and where does it come from? Capital cost is the discounting factor in Capex calculations. We will define discounting soon, but for now, it is a way of turning future money into a value today. Something that you can understand today. Discounting deals with the fact that $1 is worth less tomorrow than it is worth today. The weighted average cost of capital, the WACC, a term we will come back to, is commonly used as a discounting factor. It considers the capital cost from debt as well as the owner's equity. Companies are founded by two sources. One is credit institutions such as banks, and the other is capital from its owners. WACC equals the share of debt times interest rate plus share of equity times cost of equity. How do companies calculate the weighted average cost of capital? If our company's debt has a market value of $40 million, and the market value of our equity is $60 million, then we have 40% debt and 60% equity. If you then have a 5% interest rate or capital cost from the bank and 10% from the owners, you weight that together in a very simple calculation that looks like this. Share of debt multiplied by the interest rate plus share of equity multiplied by the cost of equity. The WACC in our example is 8%. This presentation does not sort out how you should arrive at the cost of equity, or how you should or shouldn't consider tax in the WACC. But contact us for material on that. If any of you have studied engineering at university, you probably think this math is simple. When it comes to finance, math is simple. This is more or less as difficult as it gets. Let's move on to cash flow measures of value and profitability. We begin with the net present value, or NPV. The net present value measures value, not profitability. Discounting is used to recalculate the capex's cash flow to its value today. To be able to determine if a capex you want to make today is good or bad, you need to bring its future cash flow back to today. For example, we have a capex of $50,000, and it has a life of 1 year, and the only payment that will come from this capex is $60,000 that will come 1 year from now. Additionally, you have a discount rate of 8%. To determine the NPV, what you need to do is to bring the future cash flow of $60,000 over to today, which is when you spend the money by using this discounting rate of 8%. So you discount this one time, 1 year, and this math, it is very simple. Technically, you divide the $60,000 by 1.08. The NPV is $5,555. That is the value of spending a capex of $50,000 today, given that you get $60,000 back in a year. And how should we interpret that? Well, that means that if a company was offered $5,000 in cash as an alternative, the company should select the capex value of $5,555 instead of the cash. So, you say no to the cash and choose the capex project instead. This is what the NPV calculation tries to tell us. In other words, the NPV calculation brings all the future cash flows to today, so that you can compare it today to other opportunities in the company. All the NPVs you see in a capex plan have brought the future cash flows to today, so that you can compare the capex project to all other alternatives in the company. The rule here: accept all capexes with an NPV above 0. That's the basic rule when it comes to net present value calculations. We are here telling you the textbook version of the story. Reality, though, is that you should probably say no to projects the better the NPV is. But you have to read our text, The Tail Wags the Dog, to understand that part. So as an example, you have a capex of $100. The life of the capex is 10 years, and the WACC is 8%. Every year, you get $25 back. The $25 per year are undiscounted cash flows because it is the money that you will actually get every year. You will see that exact amount of money. When we discount this, we stand in year 0 and bring the value in year 1 down from 25 to 23 by dividing by 1.08. And year 2 is down to 21, dividing by 1.08 to the power of 2, and so on. We are still standing over in year 0 looking at this. Then at the end, we need to understand the value today of year 10's cash flow, which is only 12. It's not 25 since it has been divided by 1.08 to the power of 10. The discounting depresses the numbers by the 8% every year exponentially. What you do then in an NPV calculation is that you add up all the blue ones, 23 to 12, and you compare it to the capex. You have heard the term net present value. Now we're introducing a term that we will come back to in a while. It's called present value. It's the value of everything in the future. We're excluding the capex from the calculation. It's the present value, not the net present value. The present value presents today's value of future cash flow. When you, in a second step, compare the present value to the capex, you'll get to the net present value, in this case 68. Next term, payback. Undiscounted payback occurs at the point in time where the capex is fully repaid using the capex project's future cash flow. If you have a capex of 100 and annual cash influx of 25, then your payback occurs after 4 years. Discounted payback applies the discounting factor, the WACC of 8%, on the cash flow before calculating the payback. It occurs at the point in time when a capex is fully repaid using the capex project's future discounted cash flow. In a discounted payback calculation, the capex of 100 not only has to pay back the 100, but also cover the time value of money effect, that money is worth less in the future than today. You basically need another year with 25 as cash flow to cover for the WACC. The undiscounted payback is the most common term, but it excludes the crucial discounting effect. The rule here is to accept all capexes that achieve a discounted payback. When you reach the discounted payback after 5 years, for instance, that is when your net present value reaches zero. A continued positive cash flow after 5 years will give you a positive net present value. If your company's average project has a discounted payback after 5 years, then your company would have a great stock market performance and generate significant cash flow every year. Your EBITDA would be incredibly strong. The term payback is treacherous. Sometimes you never get your money back, even if you fulfill all your assumptions in the CapEx request. Read our text, The Tail Wags the Dog, for an explanation. The next measure we're going to look at is the Profitability Index. The Profitability Index divides the present value of the future cash flow. Remember that the present value excludes the CapEx outlay, by the CapEx outlay. So for instance, in our example, the present value was 168. The CapEx was 100. So the Profitability Index is 1.68. The rule here is that you can accept CapExes with a Profitability Index above 1. It's a very simple measure. There are no flaws to it. A Profitability Index of 1 equals a net present value of 0. Those two measures are consistent and proportional. A Profitability Index of 2 gives you a present value of twice the CapEx amount. The next measure is the internal rate of return. It is not a measure we recommend since it has a few flaws, and it is not proportional to the NPV. But it isn't a terrible measure. The internal rate of return is calculated as the discounting rate that gives the CapEx calculation a net present value of 0. So in other words, if you have a CapEx which has a net present value of 0, discounting it with the weighted average cost of capital, then the internal return equals the weighted average cost of capital. And just to step back a moment, the Profitability Index is 1. You know when you have an equation and one term is unknown? In an NPV calculation, it is the NPV that is unknown. In an NPV calculation, you know the cash flow, the CapEx, the life, and the WACC. You solve for the NPV. In an IRR calculation, we do almost the same thing, but we decide to set the NPV to 0. We still know the cash flow, the CapEx, and the life of the investment. What is now unknown is the discount rate, so we solve for that instead. We will not describe the flaws of the IRR here. That's too academic. You can easily Google it. The rule with using the IRR is to accept CapExes where the internal rate of return is above the WACC. That is all for today. We just want to end today's session with a summary. Calculate your company's WACC in a relatively scientific way. Use after-tax calculations for your CapEx decisions. We can email you a text on that if you like. Absolutely do not use a hurdle rate, cutoff rate, or required rate of return higher than the WACC. That will without question lead you to making incorrect decisions. Use two measures, the NPV and the Profitability Index. Skip the IRR measure. Thank you for your time. We hope today's editorial has helped you so that you can make the best decisions for your company.